On screen text, Microsoft lost $440 billion in a day. Microsoft didn't lose $440 billion in cash. It lost something scarier, confidence fast. And in the age of AI, confidence moves markets like a mood swing. Here's what's wild. Microsoft reported strong results, but after its FY26 Q2 earnings in late January 2026, the market value drop was still described as roughly $440 billion, one of the biggest single-day hits in stock market history. Why? Not because AI failed. Because investors looked at the AI bill and felt dread. Setup. This matters now because AI isn't just software. It's infrastructure, data centers, GPU, long lead times, massive capital spending. And when the biggest AI players talk about accelerating that spend, the market doesn't only run spreadsheets, it runs emotions. In Microsoft's case, the recent context points to a clear trigger: surging AI infrastructure costs even alongside strong financials. Revenue growth, Azure growth, and big jumps in Copilot-related momentum. But capital expenditures ballooned to around $40 billion, driven largely by AI capacity needs like NVIDIA GPUs and data centers. Investors saw the pace and asked a simple question: do we get paid back in time? Bridge. A book idea helps explain this. Companies have corporate emotion. Not literally feelings, but a collective mood that shapes decisions, risk tolerance, and reputation. And here's the twist. Markets have a version of corporate emotion too. When Microsoft talks about AI like a long-term platform shift, that's one emotional signal: ambition, inevitability, momentum. But when the same story includes skyrocketing capex and questions about returns, the emotional weather can flip. Excitement turns into anxiety. Main point 1 claim: market cap moves reflect collective emotion, not just math. On screen text, corporate emotion, right arrow, investor emotion. A company is a legal entity, but it behaves like a crowd. And crowds are emotional. The excerpt says corporate emotion can be captured and measured through signals, stories, leadership tone, successes, setbacks, and what outsiders see. Now swap employees with investors for a moment. The earnings call becomes a ritual. The guidance becomes a shared story. The capex number becomes a symbol. Concrete example: imagine two identical businesses. Both say we're spending big on AI. Company adds, we're spending big, but here's where the demand is coming from, what timeline we're targeting, and how we'll keep flexibility if the hardware cycle shifts. Company B adds, we're spending big because we have to, and the timeline is. We'll see. Same spend, different emotion. One creates focused confidence, the other creates unease. Takeaway: if you want to understand a mega drop like Microsoft lost $440 billion, don't only ask what changed. Ask what did people start feeling and why. Main point 2 claim: AI capex triggers a specific fear. Will the payoff arrive before the tech expires? Cut to example: a warehouse of rapidly aging hardware. In the recent context, one of the core worries was ROI. Investors fearing AI spending won't yield returns before hardware becomes obsolete, pressuring margins if growth slows while spending accelerates. That's not an abstract concern. AI infrastructure is like buying a fleet of delivery trucks. Except the trucks get outdated fast, and the route map keeps changing. Concrete example: There's backlog growth reported, and Copilot metrics were up sharply. But if capacity is constrained, you spend a build. The moment you spend, you're betting not just on more customers, but on right customers, right price, right timing. It's the timing, and the emotional tone shifts from low investment to expensive scrambling. Takeaway, the emotional risk isn't we spent money. It's we spent money, and the clock is ticking. Main point 3 claim. Concentration risk creates dependency anxiety, which multiplies emotion. On-screen text, backlog concentration equals fragility story. The excerpt notes corporate emotion is amplified by external interactions, customers, competitors, reputation. In the context provided, Microsoft's demand backlog was described as huge, but with a concentration concern. OpenAI representing a large share. Even if the partnership is strategic, high dependency invites a fragile narrative. Concrete mini-story. Think of a restaurant that's always full because one delivery app sends almost all the orders. Great problem. Until the app changes fees, shifts traffic, or hits controversy. Suddenly, the restaurant's success feels less like strength and more like exposure. Add in public controversy, like a high-profile lawsuit tied to the OpenAI partnership, and the emotional temperature rises. Markets don't wait for verdicts to feel uncertainty. Takeaway, when one relationship becomes a pillar, the story can flip from synergy to single point of failure, and that story is emotional rocket fuel. Close. So when you hear Microsoft lost $440 billion, translated, a collective mood repriced the future of AI spending, speed, and dependency. If you want to read companies better in the AI era, track the numbers, then track the emotion behind them. On-screen text, follow for more 3-minute explanations.